In the intercorporate investment, where we would like to consider the companies that we have significant influence into, we use equity method and we use the consolidation method, and both the methods are quite interesting and quite intuitive. So one thing that you should understand is that both methods represent the same idea. Uh, the idea is that if you invest in a company where you have significant uh, influence in the decision making, you will use equity method where you will keep that investment with you and you will keep on moving that investment up and down. Now that investment that you have made, you cannot just liquidate it. There are two reasons to take it like that. One reason is that liquidation is quite expensive. You cannot liquidate a lot of part of the company yourself. And the other is that the it's like a going concern thing where you have invested, if you have invested 30% or 40% or something, then you're going to still stick to that. So the more important part here is to understand the theme and the idea about what we are going to do in the accounting methodologies and the analytical methodologies with the treatment. So equity we are going to purchase, the idea is to keep it at the price that we purchased and take it from there. On the other hand, if you buy more than 50%, or if you own some other business, it means that everything is yours and you have to consolidate everything, and the thing that is not yours, you have to mention it in terms of minority interest. So minority interest would be in both places, in balance sheet and income statement. So in the equity method, when you want to bring 30 or 40 or 45% of some other company into your balance sheet, into your income statement, you have to be careful about a few things. The first thing is that whichever thing you buy, you're going to buy it at a price higher than the book price, because the book price is the price at which the other company purchased it, but that same instrument is of higher value to them and to you. So you're going to pay the market price or the fair value. Both terms can be used interchangeably. So whenever you're going to buy something, you're going to buy at the market price. Of course, nobody cares what the book price is, because if the company can sell it at any price in the market, that would be the price of that machinery or that part. And whatever price that you pay above that would be the goodwill. So anything that's paid above the market price or above the price uh, that is called the fair value, it will be the goodwill. Now there are few things here, few trickier games here which you have to understand. So even if you buy something that is like 100 in book and you bought it in 1000, like 10 times higher, depreciation of your purchased part should go at the same rate at which the depreciation of that 100 goes on in the other book. And the next part is that when you calculate goodwill, you have to make sure that the goodwill created, is it the entire goodwill, and should you add that goodwill to the company that you buy, and that's another thing that becomes quite interesting. So there are few things here, and what would happen in both consolidation and equity method, how would things change. So when you go for consolidation, the thing that happens is that everything comes into you, but you use your cash to buy the equity, so your cash would go down in the final consolidated part, and in exchange for that you will have some equity of the other company. So just remember another thing in the consolidation, that the stock in the equity, the initial stock would be same. It would not be like you can add stock of both companies. The only thing that would work as a plug would be the retained earning, the final retained earning of the consolidated values. Whereas in the equity part, if you think it's like just replacing your cash with another account of a company that you own, and then playing around with that company. So whichever method you use, both of them would have impact of your balance sheet and income statement. And the next part about the analytical reasoning is to understand on how these would change the ratios and the performance metrics. So one company could just be using some accounting measure would depict a different kind of a ratio than the other which is using some other accounting method. So this was in short about the intercorporate investment. I hope this was helpful. Keep looking for more.